In May, the SEC proposed a rule change to offer a new semi-annual option for formal reporting of earnings. That raises all kinds of interesting questions for companies to consider about financial reporting, trading window policies, and investor relations practices. Now, for investor relations, this is a fantastic opportunity for reflection and potential change because, frankly, the vast majority of companies' current voluntary quarterly disclosure processes, meaning their earnings press releases, quarterly calls, and analyst communications, aren't generally done very well. Don't believe me? Read the transcripts of a half dozen companies' quarterly calls, including the questions from the analysts at the end, with these questions in mind. Did the companies you surveyed spend a lot of the call time reading the numbers from the press release at investors? Did the CEO spend more time patting the company on the back than providing any insightful update to future strategy or the industry outlook? And don't you think that at least several, if not most, of the analyst questions should have been proactively answered in the script? And finally, did management leave the elephant in the room question to get asked in the Q&A? Unfortunately, the answer to all those questions is almost always yes. I'm sorry, but that's a C- process. It doesn't serve investors or analysts very well. As a final proof point, do you know what many sell-side analysts do when they dial into most company quarterly calls? Well, they turn the volume way down, start working on the reports, and wait for the Q&A. That's where we are today and why the SEC's new rule proposal is such an opportunity for change. How companies respond to this new opportunity for fewer formal reporting periods is going to be interesting to see. Certainly fewer filings will be attractive to a number of company functions, but I suspect we'll see that companies who really are committed to having good relationships with their stockholders and analysts will still do fuller disclosure, such as still doing a call and a release every quarter. Now, if you're the CFO, you know the downside is sell-side analyst models getting more out of control. Assuming you're a CEO, CFO, or an IR watching here, I'm sure at some point you're looking at the screen saying, okay, Brad, but what do we do about it? Well, over 25 years of running IR at 6 different public companies, I've worked with hundreds of institutional investors and sell-side analysts. I've written 100 quarterly calls and listened to complaints and ideas and done a lot of experimenting. Before we talk about specific ideas, let's remember what our objective is. All our communications with the street should be designed to do two things: increase investors' understanding of our business and to increase their confidence in our team's ability to drive growth. Those are the two goals. And if our fundamental strategy and results are solid, those objectives translate into higher valuation and stock price. Quarterly calls are just one piece of our communications with the street, which, as I just described, we're doing a pretty poor job of. I think more communications with the street is a key strategy and objective for the IR function. So to that end, I think quarterly calls are a good thing. What I want to kill off, though, is the bad way we do them. So let's talk about a better approach. Where I think we've gotten off track is misunderstanding the difference between data and interpretation. My recommendation is to treat your quarterly call like you're the guys in the booth on Monday Night Football. Madden didn't bore you with endless data points. He cut to the chase and talked about the keys to the game and what teams are going to have to do in the second half to win. If you're going to do a call, make it color commentary. I've had CEOs and CFOs do that in two concrete ways. The CEO spends just a couple minutes talking about what they see happening in the industry for the coming 3 to 6 months. You don't have to spill your secret strategies, but investors love hearing what you're paying attention to. For the CFO, I suggest they pick the 2 to 4 most important or divergent numbers in the quarter and talk about what drove those and whether they're new trends or one-offs. As a third topic, spend a final couple minutes answering the elephant in the room question that you know everybody's already thinking. Being proactive on this shows you aren't afraid of it and have answers. And that's it, a 10-minute narrative before the Q&A that provides new information, insight, answers, and confidence. Now that's a quick answer for specific quarterly call questions. But this new self-evaluation opportunity from the SEC also opens the bigger questions about your whole year-long approach to the street. Now I suggest 3 key strategies to think about. 1, talk to the street more often. 2, improve or expand the content you share with the street. And 3, better utilize your leverage points, your multipliers to the street. Now these strategies imply potential changes to your annual investor day, your relationships with your sell-side analysts, your conference and travel plans, other people who could talk to your investors, experience or sampling opportunities, and other events or technologies you might leverage. Those are all ideas I'll explore in future videos. But in the meantime, think about killing off your bad quarterly call and whether you still do 4 or only 2, presenting a better call.